Yes, so welcome to our today's class, and I want us to start on this topic of group account. So this is a very important topic. Reason being that there is always a question coming from this topic. If you go to all the past papers, I think from back from 2015 to the last sitting, you'll be able to see a question on group accounts, or basically a question on consolidated financial statements. So maybe first of all, we need to ask ourselves, what are the group accounts, or what are the consolidated financial statements? So these are the financial statements which are prepared by something called a parent company, or by a company which is known as a parent company or a holding company, by combining or basically by consolidating similar items of assets and liabilities, revenue and expenses, those of the parent and those of the subsidiaries. So from company law, I hope you can be able to remember what is a parent company or what is a holding company, and basically what is a subsidiary. A holding company or basically a parent company, is a company which has acquired the majority of the shares, or basically more than 50% of the shares issued by another company. So the company which has acquired majority of the shares is known as the parent or the holding company, whereas now the other company is known as the subsidiary company. So like assuming in this case we have a company A, and you're told that this company has acquired more than 50% of the ordinary shares, basically which are issued by company B. So in this case, this company here is known as the parent company. In other terms, this can also be known as the holding company, whereas this company here is known as the subsidiary company. So now, this company, which is called the parent company, at the end of each year, is basically expected to prepare the group account or the consolidated financial statement. And we are saying that these group accounts are prepared by this company by combining similar items, of what? Of assets, liabilities, revenue and expenses, those of the parent company and those of who? Of the subsidiary. And in this case, it is very, very important for you to understand that these group accounts are not prepared by any other company, but purely they are prepared by the parent. So it is not the subsidiary company to prepare the group account, but the group account should be prepared by who? The parent company. So therefore, as far as this topic is concerned, we're going to look on how we prepare the group account. And also, in this case, we're going to discuss in detail some of the accounting standards, which basically governs the preparation of this particular group account. But even before we proceed to do that, to look on those specific standards, to look on how we prepare the group account. First of all, I want us to maybe look on definition of various terms. So these are some of the important terms we need to understand even before you proceed to prepare the group account. The first term here is basically called, or the first term is group. And in this case, when we talk about the group, basically this refers to the parent company and its subsidiaries. The parent company and its subsidiary company. So meaning that if, for example, we have this company and this company has one subsidiary, or maybe this company has two subsidiaries, then we refer to this as a group of companies. So the parent company and its subsidiaries are known as a group of what? Of companies. So in this case, we have said whenever you have a group of companies, then you have said that this company here, that is the parent company or the holding company, is the one which has an obligation to prepare the group account or to prepare the consolidated financial statement. So the other term we can also define here is the parent, or basically the holding company. And we say that this is a company which controls, this is a company which controls another company, and the other company which is controlled, in this case, we refer to it as a subsidiary company. So this company, the parent company, controls another company which is known as the subsidiary. Basically, control is determined in terms of checking the percentage shareholding. So if this company here has acquired majority of the shares, more than 50%, we say that this company controls the other. Though this control or basically the control does not exist, whereby a parent company has acquired majority of the shares. Generally, we say this company controls this one. Number one, if the parent company controls the composition of the board of directors. What does that mean? It means that if this company here, company A, appoint majority of the directors, in company B, so then in this case, we say that this company here controls the composition of the board of directors of company B. Number two, this company will also be deemed to be controlling this one if this company here basically do what? It controls, we can just put that there, it controls the operating and the financial decisions of the subsidiary. And actually, in this case, the parent company controls the operating and financial decisions made by the subsidiary if this company here is the one which appoints the senior managers of this company. So the parent company controls the operating and financial decision of the subsidiary by doing what? By appointing the senior managers. By appointing the senior managers in the subsidiary company. So if the senior managers of the subsidiary company are appointed by the parent company, then in such a case, we say that this company controls what? Controls a company B. So therefore, it is very, very important for you to understand here that you may be told that this company here, for example, acquired like 45% of the shares issued by company B, but company A is the one which appoints majority of the directors. It also appoints the senior managers of company B. In that case, the control exists. Yes, so in this case, we continue. So what I've said is that if you are told company A maybe acquired like 45% or even 50% of the shares in B, then you also given information that company A is the one which appoints majority of the directors in company B. Company A is the one which appoints the senior managers of company B. It basically means that company A exercises control over company B. And therefore, company A will be the parent, company B will be what? The subsidiary. So the other term we also need to define here, number 3, is the term business combination. Business combination. So what do you mean by business combination? The business combination basically we say is the event, or is basically that transaction where the parent company, acquires control in the subsidiary company. That transaction where the parent company acquires the control in the subsidiary company, we refer to that transaction as a business combination. In other terms, we say company A has actually acquired company B. That transaction itself, we refer to it as a business what? A business combination. The other term we also need to understand here, which is number 4. Number 4 is something called non-controlling interest. Non-controlling interest, or basically NCI. And NCI, this refers to the shares issued by the subsidiary company, and not held by the parent. So these are basically the shares which are issued by the subsidiary company and not held by the parent company. Not held by the parent company. What does that mean? Let's assume that we are told that this company here, that is the company A, has acquired 80% of the ordinary shares issued by company B. So it means that 20% of the shares issued by company B, 20% of the shares issued by company B, which is the subsidiary, they are not held by the parent company. The parent company only holds 80% of the shares issued by company B. And therefore, these shares, these 20% of the shares issued by the subsidiary, they are not held by the parent company. We refer to that portion of the shares as the non-controlling interest. So we say that these particular shares here are held by the minority shareholders. The minority shareholders are not in a position to control the operating and financial decisions of company B. They are not in a position to control the composition of the board of directors of company B. That's why we say they are stake. their interest in this particular company is what? Is a non-controlling interest. So these maybe are some of the terms you need to understand even before you proceed to look on how we prepare the group what? We prepare the group account. Then from there, we can proceed and look on some of the standards which are applicable in preparation of the group account. So we look on international accounting standards and also international financial reporting standards, which are applicable in the preparation of group account. So which accounting standards are applicable in the preparation of group account? So here we have a basically number of standards which are basically applicable. So let's proceed. In this case, we have various international accounting standards, international financial reporting standards, which are applicable in the preparation of group accounts. So number one, we have international financial reporting standards number 3, and basically this deals with the business combination. Remember, in this case, we have defined a business combination as that transaction through which the parent company acquires the control over the subsidiary. We're going to look on what is the provision of this standard here as far as the business combination is concerned. The other standard which is also applicable in preparation of group accounts is IFRS 10. And basically, this deals with how we prepare the consolidated financial statement, specifically whereby the parent company has made investment or has invested in a subsidiary company. How do we prepare group accounts? How do we prepare consolidated financial statements whereby the parent company has invested in a subsidiary? The other accounting standard which is also applicable here is the IFRS 11, and basically this deals with how we prepare the group account, whereby the parent company has entered in something called a joint arrangement. We will be able to discuss this later on. And then from there, we also have international accounting standard number 28, and basically this deals with how we prepare the consolidated financial statements, whereby the parent company has invested. The parent company has made investment in an associate, or basically joint venture. So these are basically some of the accounting standards which you're going to come across as far as this topic is what is concerned. I want us to start with the first standard here, IFRS 3. Which basically deals with the business combination. The business combination. So remember, business combination, we have said, is the transaction through which the parent company acquires the control in the subsidiary. Now, this particular standard requires that on the date of business combination, or basically on that particular date, when the parent company acquires the subsidiary, the parent company must determine the goodwill arising from business combination. So therefore, this particular standard here basically governs how the goodwill arising from business combination, So how this particular goodwill should be computed? Should be what? Should be computed. So first of all, what do you mean by goodwill? Goodwill, basically, this is the difference between goodwill is the difference between the purchase consideration which was paid. The purchase consideration, in other terms, we refer to this as the cost of investment. The cost of investment and the fair value of net assets acquired. Fair value of net assets acquired. So the difference between the purchase consideration which was paid by the parent company in acquiring the subsidiary and the fair value of the net asset acquired, we refer to that as what? The goodwill. For example, in this case, we may be told that when the parent company was, or maybe company A, which is the parent company, acquired like 80% of the ordinary shares issued by company B, and this company paid automatically whenever a company is buying shares of another one, that company must pay for those shares. So the amount which is paid is what you refer as the purchase consideration or the cost of investment. Remember, our company is investing in acquiring a subsidiary. So that investment costed company A how much? We may be told that this company paid 100 million. Paid 100 million. That is a purchase consideration or the cost of investment. So in this case, what we do, we compare this purchase consideration which was paid with the fair value of the net assets which were acquired. Automatically, whenever this company is being acquired, that company must revalue the assets, must determine the fair value or the current market value of each asset. So like in this case, assuming we are told that on the date this company was acquired, maybe it's a net assets. The net asset of this company had a fair value of maybe 200 million. 200 million, 200 million, or let's just take this to be 100 million, 100 million. So to determine the goodwill, we are saying we take the purchase consideration which was paid. How much is that? Is 100 million. We less the fair value of the net asset acquired. In this case, we take the net asset of this company, which were 100 million, 100 million. But because our parent company acquired 80% of the shares in company B, the parent company didn't acquire all the shares of company B. The parent company also acquired acquired net assets equal to 80%. So therefore, the net asset acquired will be 80% of this, will be 80% of that. So the difference between 100 million and basically 80 million, which is 20 million, this one we say is the goodwill arising from what? Arising from business combination. The goodwill arising from the business what? A combination. So this particular goodwill basically is determined in accordance with IFRS 3. IFRS 3, basically we are saying this deals with or governs the aspect of business what? Combination. It requires that on the date of acquisition, on the date the parent company acquired the subsidiary, in this case, the parent company must determine the goodwill arising from business combination. The goodwill arising from business combination. So naturally, I've said goodwill is the difference between purchase consideration, which was paid, and the net asset which were acquired. Now, according to this standard here, there are two methods which can be used by the parent company to compute this goodwill. Two methods of computing the goodwill. Methods of computing a goodwill. Computing goodwill. And basically, whatever we are discussing here is very, very important. Very, very important as far as this topic is concerned. You'll be able to see that even before you look on an illustration, as far as this topic is concerned, I think we will take two classes. Today's class, and in our next class, here will be an introduction to this topic. So we are laying foundation. We are laying foundation on this topic because we are saying this topic is very, very important. Whatever we are discussing today and actually what we will discuss in our next class is very important. You must understand it. Otherwise, if you don't understand what you're discussing, you will then have a problem when you start doing some illustration. Whatever we are discussing here is one of the very important concepts because you'll come across this in all questions for group accounts. So how do we compute this goodwill arising from business combination? We have two methods. We have the first one, which is called the partial goodwill method. The partial goodwill method. And number two, we have the full goodwill method. We have the full goodwill method. So those are the two methods which are used in the computation of goodwill. And basically, once we look on how we compute the goodwill under the two methods. And we will start with the first one, which is the partial goodwill method. A partial goodwill method, partial goodwill method. Now, even before we look on how we compute this, the goodwill under this method, let me have a small illustration here, assuming we have company A and this company, we are told, acquired 80% of the shares in company B. In company B, in this case, we have said 20% of the shares issued by this company, they are referred to as NCI. 20% of the shares issued by company B. Those are the shares which are not held by the parent. So under this particular method here, under this method, we compute the goodwill. We compute the goodwill of the parent company only. Under the partial goodwill method, we compute the goodwill of the parent company, because it is important to note when computing this goodwill, we are saying we compare the purchase consideration paid and the net asset acquired. Basically, the net asset acquired in this subsidiary. So the net asset of this company have been acquired by the parent company, and some of them have been acquired by who? The minority shareholders, the NCI. Let me just use that word, non-controlling interest. So the shares issued by the assets of this company, 80% acquired by the parent, and basically 20% acquired by who? NCI. We are saying under this method, we only compute the goodwill of this company. It basically means that in computing that goodwill, we will compare the purchase consideration which was paid by the parent company in acquiring 80% of the shares here, and the net asset the parent company acquired. So the net asset acquired by the parent will be 80% of the net asset of the subsidiary. That's that? Yes. So therefore, under this method, we compute the goodwill of the parent company only. So how do we compute that goodwill? How do we compute the goodwill arising from business combination? Goodwill on acquisition. The computation of goodwill on acquisition using the partial goodwill method. So here we take the purchase consideration, which was paid by the parent company. So how much amount was paid by the parent company in acquiring 80% of the shares in the subsidiary? And then to this we less fair value of net assets, acquired by the parent company. Fair value of the net asset acquired by the parent company. Like in this case, I've said to compute this fair value of the net asset acquired by the parent company, you take the parent company shareholding in the subsidiary, you multiply that with the subsidiary company fair value of the net asset at the date of acquisition. At the date this company was acquired, what was the fair value of its net assets? What was the fair value of its net asset? This is something which the examiner will not have given you, but basically will be able to explain how do we compute that. So you less that. Whatever you get here will be a goodwill, on acquisition if basically you get a positive figure, but there are some instances whereby you can get a negative figure. So if you get a negative figure, it means that whatever the parent company paid in acquiring the net asset of B was less than the net asset acquired. So if you get a negative figure there, that one is called a gain, is referred to as a gain on bargain purchase. A gain on bargain purchase. In this case, we say that the parent company was able to bargain and it acquired the subsidiary at a profit, or basically at a gain. It was able to bargain, it acquired the subsidiary at a gain or at a profit. Now, this goodwill, this one is recognized as an asset, or basically as a non-current asset in the consolidated statement of financial position. So when the parent company here is preparing the consolidated balance sheet, the consolidated statement of financial position, which is basically prepared by adding some assets and liabilities of the parent and those of the subsidiary, this one will be recognized there as an asset. As what? As an asset. But this one, a gain on bargain purchase, this one is recognized as part of the other incomes, in the consolidated income statement. When the parent company is preparing the consolidated income statement, which is prepared by combining revenue and expenses of the parent and that of the subsidiary, this one is recognized there as part of the other income. So therefore, under the partial goodwill method, we compute the goodwill of the parent company only, And basically, that is how we compute that. Purchase consideration, which was paid by the parent, minus the fair value of the net asset, which was acquired by who? The parent. But in this case, it is also important for you to note here, or basically what is important to know here, is that in most of the exam questions, the examiner will not have given you some information that use the partial goodwill method, use the full. In most of the cases, if the examiner or if the group, the parent company, or the policy of the group is to compute the goodwill using the partial goodwill method, in the additional information, you will come across this statement. You'll come across a statement that it is the policy of the group. It is the policy of the group to measure NCI at their proportionate share. Their proportionate share over fair value of net assets. So once you come across this particular statement, in the additional information is upon you to know that you use the partial goodwill method. You'll come across this statement in the policy of the group to measure the NCI at the proportionate share of the fair value of the net asset. So once you are given that information, you automatically know that when computing the goodwill, the method to be applied is what? Is the partial goodwill method. The other method, let's move to method number 2, is the full goodwill method. The full goodwill method. Now, under this particular method here, that is the full goodwill method, we compute the goodwill of the parent company and the goodwill of the NCI. The goodwill of the parent, the goodwill of who? Of NCI. Remember, the net asset acquired in this or the net asset of this company are acquired by two categories of shareholders. They are acquired by the parent company, who is the majority shareholders here, and they are also acquired by the NCI, who are the minority shareholders here. So therefore, the parent company, when acquiring 80% of the assets, it pays some purchase consideration. When the minority shareholders are acquiring 20% of the net assets here, they equally pay purchase consideration. So under this method, we compute the goodwill of the parent and the goodwill of who? Of the NCI. So the goodwill which is computed here is the goodwill of the parent company and the NCI. Parent company is the majority shareholder, NCI is the minority shareholder. So how do we compute that goodwill? That goodwill on acquisition. Using what? Using this method here, using the full goodwill method. So here we start with the purchase consideration. Purchase consideration paid by parent company, paid by parent company. So how much amount was paid by the parent company in acquiring the shares? And then to this, we add something called the NCI at fair value. So what is NCI at fair value? NCI at fair value is something which the examiner will have given you in most of the questions. So the NCI at fair value, in other terms, this is the purchase consideration paid by minority shareholders, paid by NCI. So when NCI were acquiring 20% of their shares, how much amount did they pay? So we basically add those two values. And this now will give us the purchase consideration paid by the parent and who? NCI. Then from there we proceed, and then we left the net asset acquired by both the parent and also who? NCI. So to this total amount we less and the fair value of net assets acquired by the parent and the NCI. We less the fair value of the net asset acquired by the parent and NCI. So I've said I'll be able to show you how we compute this one. So on the date this company was acquired, on the date the subsidiary company was acquired by both the parent and the minority shareholders, what is the fair value of its net asset? I've said that is something which the examiner will not have given you, but basically I'll show you how we compute that. So we then start from this amount. We can get a positive figure or basically a negative figure. So if it is a positive figure, I've said that is a goodwill. But if you get a negative figure, that one is called a gain on bargain purchase. A gain on bargain purchase. Again on bargain purchase, of which you have said this one is an asset in the consolidated statement of financial position. This one is an income in the consolidated statement of financial position. So in the consolidated statement of profit or loss. Now, this basically how we compute that goodwill using the partial, using the full goodwill method. But equally in an exam, the examiner will not tell you use full goodwill method. The examiner will never tell you that. So mostly in the additional information, you will come across this information. You'll be told that it is the policy of the group, it is the policy of the group to do what? To measure NCI at fair value, in which case the examiner will proceed and give you something called the NCI at fair value. NCI at fair value is given, or will be given, that is. Will be what? Will be given. So the examiner will give you this, the NCI at fair value. He will tell you the NCI at fair value on the date of acquisition was this particular amount, So therefore, once or for you to use the full goodwill method, usually you'll come across this particular information in the additional information. It is a policy of the group to measure NCI at fair value, and the examiner will move or basically will proceed and give you the fair value at the NCI at fair value. So therefore, that is basically very, very important as far as the computation of goodwill is concerned. We have said goodwill is the difference between purchase consideration paid and the fair value of net asset acquired. How many methods can be used by the company in the computation of goodwill according to 𝐼FRS, full goodwill method and the partial goodwill method? You must be able to know how do we compute the goodwill using the full goodwill method and also the partial goodwill method. But here there is something which is very, very important, which I've said the examiner on no question for group accounts. You'll be given that, and that is basically the fair value of the subsidiary company net asset on the date of acquisition. That is something which the examiner will not have given you in most of the questions, or actually in all questions. How do we compute that? How do we compute this? The fair value of subsidiary company net assets on date of acquisition. On date of acquisition. And basically this is the date the parent company acquired the subsidiary. So that in short form we abbreviate it as DOA. So anytime you hear of DOA, is basically the date there was what? There was a DOA. A DOA is basically a wedding. Is the date these two companies came together. Is the date this company did what? Acquired the subsidiary. The date of acquisition. So basically, this is something you will never be given in an examination. Now, net asset generally, net asset here, net asset, there are two approaches we can compute this. You can take asset of the company minus liabilities. That will give you net asset. Alternatively, you can compute net assets by taking equity of the company. Equity we know is the share capital. Share capital plus reserves. Plus what? Reserves. In group accounting, we compute the net asset of the subsidiary using the second formula. We don't use the first one. We don't use this one. Asset minus liabilities. We use this one. where we take the share capital of this company automatically on the date of acquisition, and then we add the reserves of this company on the date of acquisition. So therefore, this one is equal to the subsidiary company ordinary share capital plus something called the pre-acquisition reserves. So what do you mean by the pre-acquisition reserve? Pre-acquisition reserve, these are basically the reserves of the subsidiary, or the reserves the subsidiary company was having on the date it was acquired. On that date, when the parent company acquired the subsidiary, which reserves were in the books of account of the subsidiary on the date of acquisition. And actually, we know the reserve comprises of things like the retained earnings, the share premium, and so on. So therefore, to compute this one, what we do is that we take the subsidiary company, ordinary share capital, and then to this we take the pre-acquisition retained earnings. So this is the retained earnings of the subsidiary on the date it was acquired. We also add the pre-acquisition share premium, the pre-acquisition revaluation reserve. Let me have that here. The pre-acquisition revaluation reserve, pre-acquisition revaluation reserve, and basically we add all this. So this now will give us the fair value of the subsidiary company net asset on the date of acquisition on DOA. So this is very, very important when it comes to the computation of the goodwill. This is where majority of the students have a challenge. They are not able to compute the fair value of the subsidiary company net asset on the date of acquisition. So we compute it using that formula. A subsidiary company ordinary share capital plus the pre-acquisition reserve. These are the reserves the subsidiary company was having on the date of acquisition. On the date of what? Acquisition. So therefore, as far as the computation of goodwill is concerned, basically those are that's what you need to know. What is goodwill and the two methods of computing the goodwill, and equally this one. How do we deal with this? Now next, I want us to look on this one, forms of purchase consideration. Forms of purchase consideration. Now, purchase consideration, first of all, remember you have said that this is what the parent company pays after acquiring majority of the shares in the subsidiary. So automatically you have said that once this company acquires majority of the shares of the subsidiary, the parent company must pay for those shares acquired. The same case, if you buy shares in a company, you must pay for those shares. Now, the purchase consideration paid by this company can take various forms. So the first form of purchase consideration is something called a cash consideration. The cash consideration. Basically, cash consideration, this is a consideration which is paid in cash, and also it is paid on the date of acquisition, on the date of DOA. So is where the parent company acquires the majority of the shares in the subsidiary, it pays for those shares in cash, and that payment is made on the date of acquisition. Now, this particular consideration here has no special treatment. When it comes to the computation of goodwill, so this particular consideration has no special treatment. So we use that the amount that it is. So if you are told the parent company paid acquired 80% of the shares in B, paid a cash consideration of 100 million. When computing the goodwill, you use the amount you use that consideration as 100 million. You use it as 100 what? Million. That's why we are saying that consideration has no special treatment. Number two, we have we have a deferred consideration. A deferred what? Consideration. So what do you mean by a deferred consideration? Basically, we know to defer is to postpone something, do it in the future. So this, number one, is a consideration to be paid in future from the date of acquisition. So this is a consideration payable in the future. Consideration payable in the future. In the future. For example, in this case, we may be told that A Limited acquired 80% of the shares in B, but this company promised to pay an additional consideration of maybe 200 million in 2 years' time. So mean that this particular amount here will be paid at the end of the second year from the date the parent company acquired the subsidiary. Now, this amount here, which is to be paid at the end of the second year from the date of acquisition, remember it forms part of the purchase consideration. When computing the goodwill, which has to be computed on the date of acquisition, this amount has to be used because it is part of the purchase consideration. Therefore, as such a consideration which is payable in the future, this one has to be discounted. This one is discounted to its present value, using the parent company cost of capital. Using the parent company cost of capital. So the parent company cost of capital essentially would be your R. We know that whenever you're discounting, whenever you're getting a present value, you must have this one. You must have a discount rate. So in this case, you will always be given the parent company cost of capital. You discount it. Like in this case, let's assume that we are told company A acquired 80% of the shares in company B, and this company here promised to pay an additional consideration of 200 million, and this will be paid at the end of the second year. At the end of the second year from the date of acquisition. Basically means from the date of acquisition, this amount of 200 million will be paid at the end of the second year. We are saying because this particular amount must be used in the computation of goodwill, and we compute the goodwill on this date, we can only use it on we can only discount that amount to its present value. To do that, we use the parent company cost of capital. And then in this case, we are told that the parent company cost of capital, the parent company cost of capital is maybe 10%. 10%. So how do we discount this one? How do we get the present value of this deferred consideration? So the present value of the deferred consideration will be equal to 200 million. We multiply that with the present value interest factor at the rate of 10%, and basically for 2 years. For 2 years. That amount will be paid after 2 years. So we take 200 million, we multiply this with the formula, or basically with this present value interest factor. So in this case, you have to recall how do we compute this? It's something you did in FM. We take 1 plus R raised to power negative, and remember this is not an annuity. This is just a single amount. These are a single amount to be received after 2 years. So that is the formula which we use here. So 1 plus R, which is 10%, it will be 1.1. 1.1, we raise that to power negative 2. So our end there will be 2 years. So this will give us now the present value of the deferred what? Consideration. The present value of the deferred what? Consideration. So maybe you can work out this 1.1, which is raised to negative 2, raised to power negative 2, and this will be 200 million times 0.82 64, 8264. I hope that is what you're getting. So we multiply the two, 0.8264 times 200. So this will give us 165.28 million. So when computing the goodwill, this deferred consideration, which is a consideration to be paid in future, we don't use it as 200 million, but basically in this case we are saying we get its present value. Its present value will be 165.28 million. So any consideration to be payable sometime in the future must be discounted to its present value using the parent company cost of capital. Then we have the other consideration, because we have three main forms of purchase consideration. We have the last one, which is called the share exchange consideration. The share exchange consideration. Share exchange consideration. So what do you mean by the share exchange consideration? So this is a consideration which is paid by the parent company by issuing its own shares. The parent company issue its own shares as a form of payment. It is important for you to note that whenever a company is paying for an asset acquired, for services provided, for goods purchased, the company can pay for those goods, or the company can make the payment in cash, or the company can issue its own shares as a form of payment. You see, share is an asset. So instead of the company paying for goods or services in cash, the company can issue its shares as a form of payment. In the same case, once the parent company here acquire majority of the shares in B, so the parent company can issue its own shares as a form of payment. So therefore, this is a consideration paid. Paid by the parent company issuing its own shares. Issuing its own what? Its own shares. In most of the questions whereby the purchase consideration was in form of a share exchange, the examiner will tell you that the parent company had not computed and accounted for the share exchange consideration. So therefore, how do we compute the share exchange consideration? The share exchange consideration. So how do we compute this? So the share exchange consideration one, this one is equal to number of shares issued by the parent company. So how many shares did the parent company issue to pay the purchase consideration? And then we multiply those shares with their fair value, or basically with their market price, on the date of acquisition. On the date of what? Acquisition. In other terms, we multiply this with the parent company shares fair value or market price on the date of acquisition. Because in most of the questions for group account, so the examiner will confuse you by giving you the market price of these two companies, the market price of the shares of these two companies on the date of acquisition. So in case you're given the market price of the shares of the parent, the shares of the subsidiary, what do you use here? You use the market price of the parent company shares, because here you are dealing with the shares issued by the parent. You must multiply that with the parent company market price per share on the date of acquisition. On the date of what? Acquisition. So once you have computed this share exchange consideration, you will also be told that the parent company had not accounted. The parent company had not accounted for those shares which were issued. Which accounting entries are made here? Which accounting entries are made? So we can look on the accounting entries which are made to account for these shares which were issued by the parent company. So number one, so we debit an account which is called the cost of investment. The cost of investment. So the cost of investment, basically, this is an account whereby the parent company records the purchase consideration which was paid in acquiring a majority of the shares in the subsidiary. If the purchase consideration which has been computed here is 200 million, it should be debited in this account. And then the parent company issued shares to pay this. So therefore, what we do is that we credit the parent company ordinary share capital. And in this case, you have to recall the amount which is credited in this account. That is something we covered in the topic of published financial statement. The amount which is credited in this account is always based on the par value per share. Par value per share. You see, we have seen when computing this, we compute this based on the fair value per share, the market price per share. So market price and the fair value are two different values. So market price is the value at which the shares of the company are trading in the securities exchange market. The par value per share is the value of the share as stated in the capital clause of MOE. So those are two different values. The amount we credit here has to be equal to the par value. And therefore, if the market price per share is higher than this, the amount which is above the par value, then that one should be credited in the parent company share premium account. Share premium account. If, for example, the shares had a market price of 15 shillings, on the date of acquisition, if the shares of the subsidiary had, if the shares of the parent company had a market price of 15 shillings per share, and the par value per share is 10, so you can see the shares were issued at a price of 15, but the par value is 10. So the amount we credit in this account is always based on the value of the par value of shillings 10. And therefore, the share premium per share here will be equal to the issue price 15 minus the par value. So that is something you have to recall from what we did in the topic of group account. So therefore, we have those as the various forms of purchase consideration, the cash consideration, the deferred consideration, the share exchange consideration, and basically how we deal with those considerations, specifically in computation of group accounts. Maybe we can just pick up one question of the group account and maybe see whether we can be able to get a question with this aspect of share exchange. We have a number of them. And then we see how do we compute this share exchange consideration? How do we account for this? So we are not doing the entire question for group account, but I want us to look on a question having the aspects of share exchange consideration. We look on how to compute the same, and equally how we account for that share exchange consideration. So we're going to look on the first question here. Yes, can we go to this question here for August 2023? We are not doing automatic. We are not doing the entire question for group account, but basically I want us to look on this aspect of share exchange consideration, how we compute the same, and how do we account for that. So we go to this one, to this question here, August 2023. Question number 3. So specifically, the first paragraph, what is it? Yes, first paragraph of that question. So basically, I've said if you go through the past papers, you'll be able to see a question on this topic. This is basically a compulsory question. The compulsory question in this paper for a part. So if you are there, please confirm. I want us to just go through that first paragraph. We see what was required. And basically, we compute that share exchange consideration and we show how it was supposed to be accounted for. I hope you're there. I hope you are there. Yes. So what are we told here? What are we told? What are we told? What are we told here? What are we told? So we are told that 𝐻𝐿 Limited, a public limited entity, intend to expand its operation by acquiring investment in other entities. On 1st of November 2022, 𝐻𝐿 Limited acquired 75% equity interest in 𝐻𝐍 Limited under the following terms. Now, once you come across a question for group accounts, the first thing you do is basically to come up with something called a group structure. A group structure is what? A group structure is basically a form of a diagram which shows the parent company shareholding in what? In the subsidiary. And in that structure, you must be having the percentage shares acquired by the parent in the subsidiary, and also you must be having the date of acquisition. For example, from that information, we are told that this company, which is called 𝐻𝐿 Limited, wants to expand its operations. And we are told, therefore, this company acquired on, that is sentence 2 of first paragraph, on 1st of November 2022, this company acquired 75% equity interest. Equity interest means that this company acquired 75% of the equity or ordinary shares of the company which is called 𝐻𝐍 Limited. This basically what we refer as a group structure. From this group structure, we can tell that this is the parent company, that is our subsidiary, and then the date we have here, this is the date we have referred to as the date of acquisition, the DOA, the popular date of acquisition there. Yes. So this is the parent, this is what? The subsidiary. So that we refer to it as the group structure. So we are told this acquisition of 𝐻𝐍 was under the following terms. One, we are told there was an immediate cash payment at a fair value of shillings 13 per share on 1st of November 2022. This is an immediate cash payment. An immediate cash payment, this is what you have referred to as a cash consideration. You have said there is no special treatment as far as that is concerned. Therefore, that is not our interest as far as this question is concerned. Once we go to the other point, where we are told, remember these are the terms of payment, the terms of acquisition. We are told there was an immediate cash payment. Point 2, we are told an issue of 3 ordinary shares of shillings 10 par value in 𝐻𝐿 Limited for every 5 shares which were acquired in 𝐻𝐍 Limited. So this company here was to issue some shares as a form of payment. And then you're told the fair value of 𝐻𝐿 Limited shares for shillings 13 per share at the date of acquisition. The share issue has not yet been recorded by 𝐻𝐿 Limited. So that is basically the point I want us to deal with. So we are told that when this company acquired 75% of the shares in 𝐻𝐍, there was an immediate cash payment, which basically have referred to as the cash consideration. That is not our interest. And then we are told that this company also issued some shares to pay the purchase consideration. That is basically what we refer as the share exchange consideration. And then in the last sentence of that point 2, we are told the share issue has not yet been recorded by 𝐻𝐿. This company issued shares to pay the purchase consideration, but has not yet recorded that. It has not yet accounted and recorded the shares which were issued. In other terms, what you must do as far as that point is concerned is to compute the share exchange consideration. We have said this one is equal to the number of shares which were issued by the parent company. This formula is very, very important. How many shares were issued by this company? And then you multiply those shares with the parent company shares fair value or market price on the date of acquisition. So in this formula, the examiner will always have given you this. For example, if we go to that point number 2, are we given the fair value of the parent company shares on the date of acquisition? Who can see that price? Actually, that should be in sentence 2. Where we are told the fair value of 𝐻𝐿 Limited shares for shillings 13. For shillings what? 13. Remember, 𝐻𝐿 is the parent. So what is the parent company's share fair value or market price on the date of acquisition? So we are told the fair value of Pika Limited shares was shillings 13 at the date of acquisition. So this one is already given as shillings what? 30. No problem with that. So the problem comes here. So this one is something which the examiner will not have given you. How do we compute this one? We go back to the same point in the first sentence. We are told an issue of 3 ordinary shares of shillings 10 par value in Pika Limited. In other terms, Pika Limited was to issue 3 shares. And basically you're told the shares which were to be issued, they had a par value of 10 for every word. That is now the other important information. For every 5 shares which were acquired. For every 5 shares which were acquired. This company was to issue 3 shares for every 5 shares which were acquired. In this case, what we need to do first of all is to determine how many shares did the Pika Limited acquired in Shiba. That is the first thing we need to determine. So how do we determine the shares issued by this company? So to determine the shares issued by this company, you go to its statement of financial position, specifically at the equity. That's where you can be able to get information about what? The ordinary share capital of this company. You take the share capital of this company, this what we're doing in the topic of publish. You take the share capital of this company, the share capital, you divide that with the par value. That will give you the shares issued by Shiba. So definitely, if you go below there, you'll be able to see we are given the statement of financial position of the 2 companies. Can you give me the share capital of Shiba? The share capital of Shiba, which is the subsidiary. Give me the share capital of Shiba. I see whether you can be able to get that information. The share capital of Shiba. Share capital of Shiba. What are you getting? What is the share capital of Shiba? The capital of Shiba. I need to get that answer from each of you. I've only gotten the answer from Helen. I need to get the answer from Martha, from Aaron, from Zipporah, from Virginia, from Hassan. So can you give me the share capital? Can you give me the share capital of Shiba? The share capital of Shiba, this company, is 80,000. Still in the balance sheet, where we have the one ordinary share capital, I hope you can see we are told the value of each share is 10. That applies to the shares of Pika. That also applies to the shares of Shiba. So to determine the shares issued by this, we take its share capital, divided that with the par value, which is 10. So the shares issued by this company, that is Shiba, are 8,000. So what are we interested with here? We're interested with the shares Pika acquired in Shiba. And you have to be very keen here. So the parent company didn't acquire all the shares. The parent company only acquired 75% of the shares. So the shares acquired by Pika in Shiba will be 75% of the shares issued by Shiba. So this company has acquired 75% of the shares of Shiba. The shares of Shiba are 8,000. So this will give us what? Will this give us 6,000 shares? 6,000 shares? 0.75. Yes, 6,000 shares. 6,000 shares. And we say, please try to hurry up because of time. Computation of that should not even take 3 seconds. 0.75. 0.75 of 8,000. What are you getting here? Yes, what are you getting? What are you getting? Yes, so this will give us 6,000. This will give us 6,000 shares. So the shares are acquired at 6,000. So what we need to do is basically to determine the shares which were acquired. Sorry, the shares which were issued by this company. Sorry, the shares issued. So we cross multiply, then we divide. So we will take 3 times the shares which were acquired as 6,000 divided that with 5. Divided that with 5. So this will give us what? So 1, 12. So this will give us that 600 shares. So that is 600 shares. That is 600 shares. That is 600 shares. These are basically the shares which were issued by who? By Pika Limited. That's basically what we wanted to compute. The shares which were issued. So having that, then we can move and we compute the share exchange consideration, which will be equal to this. The shares which were issued by the parent company, that is 600 shares. We multiply those shares with their fair value, which is 13 shillings. 13 shillings. And this will give us a share exchange consideration of how much? Share exchange consideration of how much? That is 600 times 13. That will give us 46,800. 46,800. Yes. So that's basically how we compute that share exchange consideration. Then, how do we account for this share exchange consideration? The accounting entries. The accounting entries. How do we account for this share exchange consideration? So we have said we debit something called the cost of investment. The cost of investment. The cost of investment would be 46,800. And then in this case, we have said we credit the parent company ordinary share capital. So to credit share capital is to add. That's what we know. We credit the parent company ordinary share capital with an amount equal to the par value. So we take the shares which were issued by the parent company, which we know they were 36, and then we multiply that with the par value per share. Who can tell us what is the par value per share? What is the parent company? What is the par value? The par value of the parent company shares. This is the value we have within the balance sheet. The value we have within the balance sheet is what? Is 10. So the amount to be credited in the parent company share capital will be 36,000. And because the shares were issued at a market price of 13, the amount which is above 10, which is 3 shillings, that is a share premium. So that share premium will be credited in the parent company share premium account. So the amount to be credited in the parent company share premium account will be equal to the shares issued by the parent company times the amount of premium. The premium per share is 3 shillings, the amount which is above 10, So that will give us what? Give me the amount of the share premium. The amount of the share premium. So the share premium here will be 10. Will be 10 what? 10,800. Will be 10,800. So that's basically how we compute and then account for something called the share exchange consideration. That's how we compute and account for the share exchange consideration. This kind of very, very common concept as far as this particular question for group accounts are concerned. I want to give another question, which basically will be taking as an assignment. This one, December 2022. December 2022. Okay, just go to this question. I can see we have, I want us to end at 3:40. I can see we have like 7 minutes. So can you go to this question here? December 2022, which is basically question number 3A. We try to hurry up. I want us exactly by 3:40. 3:40, we end our class. I know you have maybe another class after this. I want you to take a short break before you start the other class. That's why even I've not given you a short break. I want you to give you a short break of 20 minutes before you join the other class. You have this question with you? If yes, please confirm. If yes, please confirm. Please confirm. I will be able to proceed reading that question. I hope you already have there. You already there. So what are we told? We are told that specifically we go to the first paragraph. We are told on 1st January 2022, H Limited acquired 80% of 4 million shillings 10 ordinary shares of S at par value. And then you're told the acquisition consideration consisted of 3 shares issued by H Limited in exchange for every 5 shares in S. So that is a share exchange consideration. And then you're told additionally, H Limited pays a further consideration on 31st of December 2022 of shillings 11 per share acquired. And then you're told H Limited cost of capital is 10%, and the discount factor at 10% is 0.9091. So that is still that is a deferred consideration, a consideration to be paid in the future. So we are told at the date of acquisition, the fair value of the ordinary shares of H and S were 15 and also 12. So in that case, we have two considerations. I want us to deal with both of them. We have the deferred consideration and basically the share exchange consideration. The share exchange consideration. So maybe we can start with this one, which we have said to compute this, we have to determine the number of shares which were issued by whom? Which were issued by the parent company. How many shares were issued by the parent company? We multiply those shares with the parent company fair value. That is the parent company shares fair value or market price on the date of acquisition. So let's first of all, we will compute this one. So we go back to the information we have in paragraph 2, and I think there is something I've forgotten here. Remember, you have said that once you come across a question for group account, the first thing you should have always is the group structure. Basically, for you to know out of those two companies, which company is the parent and which company is the subsidiary. Maybe first of all, you can have that here, the group structure. And basically, we are told that in the first paragraph, we are told on 1st January 2022, H Limited acquired 80% of 4 million ordinary shares of shillings 10 of S Limited. And basically, the acquisition took place on 1st of January 2022. It basically means that this is our parent company and this is our subsidiary. And this date which we have here is the date of what? Acquisition. That is very important. Very, very important. So having this, let's go back to paragraph 2. And we are told the acquisition consisted of a new issue, and sorry, consisted of 3 new ordinary shares issued by H. So we need to compute this because this one is already given. So how many shares were issued by H? So we are told H Limited was to issue 3 shares. 3 shares for every what? For every 5 shares which were acquired. For every 5 shares which were acquired. So in this case, we have said we need to determine how many shares did H acquire in S. So if you check on the information we have down here, you'll be able to see that we don't have the statement of financial position of S, meaning that we can't be able to get the shares issued by S in its balance sheet. But if you go back to paragraph 1, you read that point well, you'll be able to see we are given the shares issued by S. And we go back to paragraph 1. We are told on 1st January 2022, H Limited acquired 80% of the 4 million shillings 10 ordinary shares of S. So the shares issued by this company S are 4 million. That information is given. So therefore, we need to determine how many shares did H Limited acquired in S. The shares acquired will be 80% of the shares issued by S. That is 4 million. 4 million. And basically, this will give us 3.2 million shares. 3.2 million shares. So we want to determine the shares which were issued. We cross multiply, then we divide. We have 3 times 3.2 million. We divide that with 5. So this now will give us the shares which were issued. This will give us what? This will give us what? Yes, I'm given that figure in 1,000 of shillings. In 1,000 of shillings, I'm told that this one would be 1920 shares, but in 1,000 of shillings. So having that, what would be our share exchange consideration? We take this one, which are the shares which were issued, 1920. We multiply that with the parent company share fair value on the date of acquisition. And actually that information, we have it up there in paragraph just above the statement of profit or loss. So we are told there is a paragraph which reads, at the date of acquisition, the fair value of ordinary shares of H and S that is the fair value of the ordinary shares of H and S was 12 and was 15 and 12. So what we're interested with here is the parent company share fair value. Is that 15 or 12? On the date of acquisition, what is the market price of H Limited shares? Is it the one which is 15 or is it the one which is 12? 15 or 12? That one is 15, is 15, is 15. So this is how we compute the exchange consideration. Exchange consideration times what? Times 15. So this will give us 28,800. 28,800 what? 800. So that is the share exchange consideration. The share exchange what? Consideration. The share exchange consideration. Then, and we deal with this one, the deferred consideration. We go back to the information we have in paragraph 3. We are told additionally, H Limited, which is the parent, this one, additionally, H Limited will pay a further consideration on 31st of December 2022. So remember, the date of acquisition is 1st January 2022. We are told this company will pay an additional consideration on this date. Basically, you can see this exactly after 1 year. After one what? Year. So that is a deferred consideration to be paid 1 year after acquisition. So we are told it will pay a further shillings 11 for every share acquired. So we need to compute how much amount will be paid. It will be equal to 11 shillings for every share acquired. So how many shares did H Limited acquire in S? I hope you can remember you have computed that down here. The shares acquired by H in S, we have said were 80% of 4 million. So the shares H Limited acquired in S were how many? 3.2, 3.2 this one. So therefore, the amount to be paid after 1 year will be 11 shillings per every share acquired. We take 11 shillings times the shares which were acquired. So this is the consideration to be paid after 1 year. We multiply that with the present value interest factor, at which rate we are given the parent company cost of capital, which is 10%, and basically this will be paid after 1 year. Will be paid after 1 year. Answer? Yes. And I think in our case, this figure is already given for us. Is given because in terms of how we compute this, we should take 1 plus R raised to power negative n. It should be 1.1 raised to power negative 1. And this is the one which should give us 0.9091. And basically that is what here given. Is that what we should get there? Maybe you can just confirm. 1.1, we raise that to -1. Yes, it should give us that. So therefore, the present value of the deferred consideration would be equal to this. will be equal to this, which is what? 11 times 3200, and that will give us 35,200. So basically, whatever you get here times this, and basically it is equal to that. So what are we getting here? Times 0.9091. 91. So basically, in that case, I'm getting the present value of the deferred consideration as that amount. So as that amount. If you work out with this one, Aaron, if you work out with that, it should give you exactly 32,000. 32,000. 32,000. Are you getting that? Yes, 32,000. So basically, that is how we deal with that particular aspect of deferred consideration and also the share exchange what consideration. So once we meet now in our next class, we will be able to proceed and basically look on how we prepare the consolidated financial statements, specifically whereby the parent company has invested in what? In a subsidiary. So therefore, for today, I want us to stop at that point. We will continue from there in our next class. But even before we meet, can you ensure you have looked on what you have discussed today? Yes, because it is very, very important. Goodwill and also the various forms of purchase what? A consideration. So have a nice weekend. Let's continue from there on Tuesday. million. For the partners made the foreign drawings during the year which ended 30th of June 2024. So we are given the drawings basically for Anne up to 31st of December 2023. Remember, Anne retired on that date. And that's why we are given the drawings for Anne up to that date. We are given the amount, and then we are given the drawings for Ben and Chad up to the end of the year. The year is ending 30th of June 2024. And then you're given the depreciations, basically how to compute those depreciations. Let's compute that as we prepare now our income statement yes. So number 3, we are told allowance for doubtful debt is to be increased to 48,000. So in that case, we're going to determine the increase, which you're going to account for as an expense. And then number 7, you're told balance due to Anne was to remain in the partnership, carrying no interest until 1st of July. Remember, we have said the partner who is retiring should be given back some amount of money. I'll be able to show you how we compute that. But in this case, we have said that amount of money should be given to the partner immediately. If it is not given to the partner immediately, it is retained in the partnership business, and the partnership will be treating that as a loan from the retired partner. We have said in most of the cases, it attracts interest. But in this case, we are told that amount due to Anne was not to attract any interest. And then you are told number 8, the value of partnership goodwill on 31st of December 2023 was agreed by the 3 partners as 4 million, and then was not to be maintained or was not to remain in the books. So it basically means that that goodwill was to be written off immediately. So you have to remember, how do we account for this goodwill? So we debit the goodwill account, we credit the partner's capital account using the old profit and loss sharing ratio. That is upon the valuation of goodwill, and then immediately we write it off by debiting the partner's capital account, crediting goodwill using the new profit and loss sharing ratio. That's basically what you're going to do. And then you're told number 9, on 31st of December 2023, that is the date the partner retired, the partners agreed to value land upward to 3.2. So it basically means that we have a revaluation gain on land. So in this case, we said such a revaluation gain should be shared among partners using the profit, using the old profit and loss sharing ratio. So in this case, we debit land with the increase in the value, and then we credit the partner's capital account, and that will be shared using the old profit and loss sharing ratio. Number 10, we are told to assume profit accrued evenly throughout the year. I'll be able to explain what is the meaning of that. What are we required to do? We're required to prepare the statement of profit or loss and appropriation account for the year which ended 30th of June 2024, and the statement of financial position. So what is important first of all here is to note the date when Anne retired from the partnership business. So this will be the workings. So the first information we need to have here is regarding the retirement of Anne from the partnership, from partnership. So first of all, the financial of this partnership business, if we go to the requirement, the year is ending that year of June 2024. So automatically the next year will start 1st July. So this year, therefore, you can say started on 1st July 2023. So when did our partner retire here? As per the information we have in paragraph 2 up there. So this partner retired on 31st of December 2023. So in this case, we need to determine how many months do we have here before retirement and how many months do we have here after retirement. Automatically here we have 6 because we count from 1st January 2024 to 30th June. So we have 6 months, and equally here we have what? 6 months. Now in this case, I've said this partner who retired, that is Anne, will basically be entitled to share the profit of partnership before retirement. She will be entitled to the salary, if any, the interest on capital for the first 6 months. But after retiring, she will not be entitled to those appropriations. That's her? Yes. So therefore, once we have gotten the profit for the year, so before we distribute it to partners, we have to apportion that for the two periods, the 6 months before retirement and after 6 months after retirement. So what I want us to do, I want us to go straight to preparation of what is required in part A, the statement of profit or loss and appropriation account. Appropriation account, basically for the year, which ended on this date, 30th of June 2024. 30th of June 2024. 30th of June 2024. That year of June 2024. So we start by having the sales here. So we need to have two columns, and I hope you can see below the information we have at the paragraph 2, at paragraph 3, figures are in thousands of shillings. So we will start with the sales of the partnership. So how much is the sales? The sales, I can see that within those balances. Remember, this is not a true balance; these are just balances, and I can be able to see sales down there where we have the capital, the current account, the purchases. Below that, I can see we have sales, which is an amount of 9880. Then we need to check: do we have sales return or return inwards? In our case, we don't have. From those balances, we don't have sales return. So basically, it means that we move and compute the cost of our sales. So the cost of sales, this one will be equal to the opening inventory. And basically, the opening inventory, this one, we have it in note number 1, additional information number 1. So let's go to the additional information note 1. And we are told the inventory was valued at 1.62 and 1.8 on 1st July and 31st June. So 1.62, that is the opening inventory. The opening inventory is 1620. Remember, all our figures are in thousands of shillings. When taking figure from the additional information, we must omit the last 3 zeros. So to this, then we add what? Purchases. And basically, purchases is below these sales, or actually above these sales, which is an amount of 5820. So we add that. Then we check whether we have purchases return or return outwards, which we don't have. We check whether we have carried inwards, which equally we don't have. So meaning that in this case, we can proceed and we get the goods available for sale. The goods available for sale. So the goods available for sale basically will be 4, and this will be 7. Will be 7. So someone to confirm whether that is correct. Is that correct, Evans? Is that correct, Purity? Okay. Huh? Eunice, you think she's what? 7620. Eh? 5820, 1620. Please, let's try to hurry up. I want us to finish this question. If we leave it hanging, it is another mess we are doing. Yes. So to this, we list the crossing inventory. The crossing inventory is in note number 1. Let's go to note number 1. Note number 1, we have the crossing inventory of 1.8. We list it. And basically, we get the final figure of the cost of sales. We take it to the last column. So this will be 0, 4, 6, then 5. 5. That is basically what I'm getting. Okay. So then let's get the gross profit. So the gross profit will be what? The gross profit will be 4240. Yes. And then to this, basically, we should check, do we have any other income? So other incomes include things like the discount received rent received. And I think below the balances we have at the paragraph 3, we don't have any income there. Also, for the allowance for doubtful debts, remember, as per the information we have in note number 6, allowance for doubtful debts is to increase. So it basically means that in our case here, we don't have any other income. So what we need to do is we basically proceed and we less the expenses. I want us to deal with first of all, we deal with expenses affected by the additional information. So we will go straight to note number 2. Note number 2, we are told at the end of the year, rent and rates were paid in advance. So let's first of all deal with that. And the rent and rates. So first of all, we take the amount which we have below paragraph 3. So the rent and rate, I can see that below the staff salaries and wages, which basically is an amount of 500. So in this case, we are told there is an amount which was prepaid. So an amount prepaid, we less it here. We get what? 400. So then note number 3, we are told general administrative expenses, there was an amount which was accruing. So we take the general administrative expenses. So the amount below paragraph 3, which is the 284, and then to this we add the amount which was accrued, which was 88, as per note number 3. So this will give us a total of what? 372. That is the figure I'm getting from Zuma. Okay. So then note number 4 is about drawings, which is not an expense. Then let's go to note number 5 and basically compute the depreciations. We compute the depreciation first of all on buildings. And in that case, we are told note 5, depreciation is to be provided on straight-line basis. Straight-line, we compute the depreciation based on the cost. So we take the cost of the building. So where do we have the building? Building is the second item within those particular balances. The first item is land. Below that, we have building, which is 6,400. So what is 2%? 2% will be 128. And then we go back to note number 5. We compute depreciation on equipment, which will be 15% still of the cost. The cost of the equipment, which is up there, which is 960. So this will give us what? I'm told by Zuma, it will give us 144. 144. As a figure I'm getting from Zuma there. Is that what you're getting? 15% of this. Okay. So then we are done with the note number 5. We go to note number 6. We are told allowance for doubtful debt is to be increased to 848. So in that case, we need to determine the increase. The increase in allowance for doubtful debt. So we need to compare this with the amount we have in the trial balance. The allowance for doubtful debt in the trial balance, okay, we are told is to be increased to 48. So the allowance for doubtful debt in the trial balance, is 42. And then in note number 6, we are told is to be increased to 48. So we determine the increase. The increase is what? The increase is 6. So 6 is now what we recognize here as an expense. We recognize here as what? As an expense. The amount to be deducted from the receivables will be this one. So we are done with that. So numbers 7, this has nothing to do with it, will not affect our expenses. Note number 8, the valuation of goodwill will not affect this. Note number 9 is the valuation of land will not affect this. And then note number 10. So can we go back to the trial balance or to those balances? We see, is there any expense which you have not captured here? We can start from the last item. The last item is basically bad debt written off. Bad debt written off is basically the other expense. Which is 18. which is 18. So above that, we have general administrative. We have already dealt with that. Rent and lease, we have dealt with that. Below that, we have the staff salaries and what? Wages. So that will be the other expense. And the wages, which is how much? 1172. 1172. 1172. Then below that, above that, we have sales, purchases, current account, capital, bank, allowance, payable, receivable. Yes. So in our case, we don't have any other expense. We don't have any other expense. So basically what we need to do is we do what? We basically get the total expenses here. So let's get the total expenses. We get the total expenses so that we deduct that from the gross profit. We deduct that from the gross profit, and we get the profit for the year. The profit for the year. Profit for the year. Okay, total expenses I'm told is 2240. 2240. So we less that from the figure we have up there, and we get what? Are we getting 2,000? Yes, we get a profit of 2,000. 2,000. Now, this particular profit, then we are saying we need to split it into the two periods. Before we proceed to the appropriation account, we need to apportion that profit for the two periods, the period before retirement and after retirement. Because we are saying Anne, who retired here, will only be entitled to share the profit for the first 6 months. Will not be entitled to share the profit for the last 6 months. So therefore, what we do here, after this, we have now two periods. The first 6 months before retirement and the last 6 months after retirement. In other terms, you can have this as the period before retirement, and then this is the period after retirement. After what? Retirement. After retirement, like that. So we apportion that profit for the two periods. And how do we apportion this profit for the two periods? We are going to use the information which are given in the last note. Which are given in the last note. Which are given in the last what? In the last note. So in the last note, what are we told? We are told that the profit is assumed to accrue evenly throughout the year. So if you're told the profit accrued even throughout the year, it basically means that the profit which was reported or which was made in each month, or the profit made by this partnership in different months was the same. So therefore, to apportion the profit for these two periods, we apportion that on time basis. For example, in this case, to compute the profit for these 6 months, we take the profit for the whole year 2000 times how many months do we have here? 6 all over 12 months. In other terms, this is basically the same with half, which is 1,000. Which is what? Which is 1,000. Sasa? Yes. So then from there, we know how we prepare the appropriation account. So to this one, we add interest on drawings. Interest on drawings. So if you check on this question here, there is nowhere we are told that the partners were charged interest on drawings. Or do we have such information that the partners were charged interest on drawings? Any such information, Purity? No, we don't have that information. So then what we need to proceed and we less the appropriations. We less the appropriations. We less the appropriations. So the appropriations, we need to check which appropriations were the partners entitled to. Were they entitled to salary? Were they entitled to what? Were they entitled to what? To interest on capital and so on. So as per the information which you're given, I think in the first paragraph, we are told Anne, Ben, Chadi were operating partnership, and basically we're given information about how they were sharing profits. The other information, we are given information about the retirement of Anne. There is nowhere we are told the partners were entitled to salary. No such information. There is nowhere we are told the partners were entitled to interest on capital. Yes, nowhere. So meaning that one, the partners were not entitled to interest on capital. They were not entitled to a salary. They were not entitled to what? To salaries. Salaries to partners. To partners, they were not entitled to that. So in our case, we will only have one appropriation, and basically that is share of profit. So this question basically is very, very simple, because one of the items which makes these questions to be more complex is this one. We will be able to do another question maybe during our revision, whereby the partners, if the partners are entitled to interest on capital, that this question become not difficult basically, but it involves some work here, because even before you compute this one, you have to prepare the partners capital account. The partners capital account. But in our case, we don't have, we just need to share the profit here because they are not entitled to that. So in our case, we need to have the three partners, and then we have Ben, and we have Chadi. So basically what we know is that for the first 6 months, all partners were there for the first 6 months, including Anne, who retired. So basically what we know is that this partner retired in the last 6 months. So Anne will not be entitled to share profit here. So in fact, we can share out this profit after retirement because, okay, let's start with the sharing the profit before retirement. We are going to use the profit and loss sharing ratio we have in the first paragraph. In the first paragraph, we are told before the retirement of Anne, partners were to share profit in the ratio of what? 5:3:2. That is basically for Anne, Ben, and who? Chadi. So basically we get the total here, which will be 10. This plus that is 10. So Anne was entitled to share a profit equal to 5/10. This one, that is Anne, Ben, 3/10, and Chadi, 2/10 of the amount to be shared. The amount to be shared as profit is this one. The amount to be shared as profit is what? Is 1,000. Is 1,000. Is what? Is 1,000. So basically this will give us what? This will give us 500. This will give us 300. This will give us what? 200. And actually, this one we can record it here as a negative, such that after sharing that amount, we get what? We get 0. We get what? 0. Then after retirement, in paragraph number 2, we are told on 31st of December 2023, Anne retired from the partnership and left Ben and Chadi to continue the partnership sharing profit and losses equally. So after retirement of Anne, we are saying Anne will not be entitled to share profit here. This profit will be shared equally between Ben and Chadi. So if we share that equally, that will be 500, 500, 500, 500. And basically we are done. We are done. So that is what was required in part A. Basically by doing that, you get your 10 marks. Now, before we move to part B, what we are required basically to prepare the statement of financial position, I said there are 2 accounts you must always prepare: the partner's capital account and the partner's current account, and then you finalize by preparing the statement of financial position. I hope you're together up to that point. Is there any question up to that point? Is that well understood what you have done here? Eunice, Purity, have you understood what you have done there? Have you understood what you have done there? Please confirm. Please confirm. Yes. So what I want us to do, I want us to prepare the partners. Let's start by preparing the partners. What current account? Is that the case? Yes, let's start by preparing the partners current account. And then we finally prepare the partners capital account. So this account, that is the partners current account, partners current account. So we will have the details column, and basically columns equal to the number of partners. We have 3 partners. We can just use A for Anne, B for Ben, and C for Chadi. So that will be the debit side. On the credit side, we have A, we have B, and we have who? We have C. No, Peter is not a must. We are doing this basically for us to be able to remember what we should record there. Sasa is not a must you record them there. So, but this is basically for us to be able to remember which appropriation we have there. Sasa, yes. On the salary and interest on capital, is it a must to record them where? Yes, it's not a must. Just I'm recording them there so that you can be able to remember what do we record there. Sasa, yes. So what I want us to do in this account, in the partner's current account, we start by recording the opening balances. The opening balances, we have them below paragraph 3 up there. So, and I hope you can see those balances, the current account balances at the start of the year. For Anne, basically we are told is a credit balance for Anne. So we start by recording the current account balance for Anne, which we are told is a credit balance. Remember, this is a credit side, and then this is a debit side. For Anne is how much? For Anne is a credit balance of 60. And then for Ben, we are told is a debit balance. I hope you can see that for Ben. So being a debit balance, we record it on this side for Ben, which is 40. And then for Chadi is a credit balance. So for Chadi, we record it here. We record those balances like that. So for Anne, Chadi, they are credit balances. For Ben, is a debit what? Balance. And then what else do we record in this account? I hope you can be able to record on this side. We record the drawings. We record the drawings. So the drawings, we have them in the addition information number 4. Let's record those drawings in note number 4. So the drawings for Anne up to the date of retirement for 20, 740, and 720. Those are the drawings. What else do we record on this side? The interest on drawings. Interest on drawings, in this case, we don't have such. What we also record in this side is the share of loss. Is the share of loss. Share of what? Of loss. Equal in this case, we don't have share of loss. What do we record on the credit side? We record the interest on capital, which equally we don't have. We record the salary to partners, which in our case is still what? Nil. And also we record what? We record the share of profit. The share of profit. Now the share of profit, we have it, but you can see the share of profit which we have here is for the first 6 months, for the last 6 months. So the amount we record here should be the share of profit for the whole year. The share of profit for the whole year for Anne will be 500 plus this one, which will give us 500. For Ben, it will be 300 plus this, which will give us 800. The share of profit for the whole year for Chadi, 200 plus 500, which will give us what? 700 like that. So those are the items which you record here. So then from there, what do we need to do is basically to balance our current account. So let's balance this. So when we have to finish this particular question, I usually avoid leaving a question which is hanging, because we always have a challenge if we start with that question in our next class. So I want us to balance this. Let's balance this. And basically we start with the current account for Anne. For Anne. So what do we have on this side? 560. On this side is less. So we have 560, both sides, 560. But now, remember, Anne retired. Are we going to have this as a balance carried down? The difference here. So how much is the difference? 560 minus 420. We have 140. 140. So will this be a balance carried down? No. So what we do, this one, we take it to the capital account for Anne. What we want to do by the end of the day is to compute how much amount was supposed to be given back to Anne on her retirement. We know she retired. So she will be given an amount of money equal to the balancing figure in the current account and the balancing figure in the capital account. So this one, we cross it off to the capital account. It will not be a balance. So this one, we take it to what? To the capital account. To the capital account, to the capital account. Let me do away with that share of loss so that it creates some space here. So that one would be taken to the capital account. And basically I've said is what? Is 140. Now, but for the other partners who were left, the balancing figure will be recorded here as a balance carried down. So this one would be 800. This side is more, 800. So and this is 780. So we will have a balance carried down of 20. So what about Charlie? 740, yes. So this is more, 740, 740. So we have a balance of what? Of still 20, So then from there next, we need to prepare the partner's capital account. The partner's capital account. So why do we need to prepare that account? Because there are two items we need to account for there. The valuation of goodwill, the goodwill which was valued, and also its writing off, and also remember there was an asset which was valued that is large. So let's do that. I think now I can do away with this one. So we prepare the partners and the partners capital. The partners capital account. Yes, so the partners. So here we have the details column. And basically columns equal to the number of partners and Ben, Chadi. On this side, we have the details and Ben and who and Chadi like that. So someone saying, tried this question. No, no. If you do that is wrong. If you do that is wrong. So you have to prepare one current account. You can't prepare that the first one for 6 months and the other one for 6 months. You see, a current account we want to determine the partner's current account balances at the end. There is no you can prepare two. Okay, you can prepare two by the end of the day, but it will be a lot of work. So maybe the balance you get in the current account for the first 6 months, it will be the opening balance in the other current account, but it will be a lot of work. Sasa? Yes. So just prepare it like this. Is that okay? Yes. Never prepare for the two periods. So what do we start by recording in this account? We start by recording the opening balances. So this account always has a credit balance, because this is capital. So where do we have those balances? Those balances, we have them within or basically below the information we have. In the information we have below paragraph 3. So the capital account for Anne is 36. 36 for Ben, 34 for Chadi is 32. And actually you can see those accounts, all of them, they have a credit balance. Now here, we need to account for two items, the goodwill. Goodwill, we have that information in note number 8. Note number 8. So goodwill, we are told in note 8, the value of partnership goodwill on 31st of December, this is the date of admission. So it's the date of retirement, because that is when the goodwill is valued. So the goodwill on that date was valued at 4 million and was not to be maintained in the book. So we said, how do we account for this goodwill? Once the goodwill is valued, we say debit goodwill account because this is an asset, and then we credit the partner's capital account partner's capital account using the old profit and loss sharing ratio. Using the old profit and loss sharing ratio. I hope you can remember the old profit and loss sharing ratio is 5:3:2. So basically, this will give us a total of 10. So this partner will be entitled to share profit equal to 5 all over 10 times 4,000. This one, 3 all over 10 times 4,000. And the other one, 2 all over 10 times what? Times 4,000. So basically, this one will be half, which will be 2,000. This one will be 12. And the other one will be 8. So that's basically how we account for the goodwill, which has been valued. So debit goodwill account, credit that account. We don't have to prepare the goodwill account. So then from there, we need to write off that goodwill immediately. How do we write off the goodwill? So we debit the partner's capital account, we credit the goodwill account using now the new profit and loss sharing ratio. Using the new profit and loss sharing ratio, just like what we did in case of admission of a new partner. And actually, we know after Anne retired, the two partners who are left, Ben and Chadi, they were sharing profit and losses equally. So we have goodwill written off. So that will be debited in the capital account of Anne and who? Ben. So equally. So 2,000, 2,000 like that. We have written off that goodwill. So the accounting for the goodwill in case of admission, in case of retirement is the same. So then from there, I want us we account for note number 9. In note number 9, we are told on 31st of December 2023, the partners agreed to value LAD upward to 3.2. So what we need to do, we are told LAD was revalued upward to 3.2 million. So what was the value for LAD before? It was valued. That information, we have it below paragraph 3. So the first item we are given is LAD. Its value was 2.4. So it was revalued upward with an amount of how much? Is it 800,000? 800,000? 800,000, yes. Now this 800,000, how do we account for this 800,000? So this one will be debited in LAD account. We will increase the value for LAD. You see, the opening balance in LAD account is this one. We debit that account with 800 to make it 3.2, and then we credit the partner's capital account, but in this case, we use the old profit and loss sharing ratio. We use the old profit and loss sharing ratio. So that gain will be shared among all partners, including the partner who is retiring. So, and these are the ratios. 5 all over 10, which is basically half, and that is 400. 3 all over 2 times 800, and basically that will be 240. And then 2 times 8, which will give us what? 160. Which will give us 160. Which will give us 160. 160. 160. I think we are also done there. We are also done. We are also done. But before you proceed to balance this account, specifically the capital account for Anne, we need to transfer this balance here. You remember this balance, which was in the current account for Anne? We said we cross it off to this account. We just follow the rule of double entry. You can see this amount is debited in the current account. Is debited in the current account. In the capital account to complete the double entry, we credit. So we will say from the current account of Anne, we have a balance of what? 140. So the reason why we are doing that, we want to know how much amount was supposed to be given to Anne on her retirement. So if you're exiting from partnership business, you must be given back the capital you had contributed, and also any amount of money you are entitled to as a result of share of profit and so on. So this is the balancing figure from that. Basically, having that, we need to move and balance this account, this capital account. And we will start with that for Anne. So basically, we add what we have on the credit side. This one will be 56,000. 6,140. Is that what you're getting? 6140. 6140. 56. 6,000. 6140. Nicole, you're getting that? Yes. Now that, remember, Anne retired. So this is basically the amount Anne was supposed to be given. But if you can be able to record the information which you're given in note number, what? Note number 7. In note number 7, you're told balance due to Anne was to remain in the partnership carrying no interest until 1st July 2024. 1st July 2024. It basically means that Anne retired here. She will be given back the money. She will be given this money on this date. So basically, we said that will be treated as a loan from Anne. So that one will be treated as a loan from Anne, which is this one, 6140. It is also important for you to note, because this amount will be paid within a year. Will be paid within a year, because here it will be paid on this date within a year. This one, in preparing the statement of financial position, it is a current liability. But if it was payable for a period exceeding 1 year, we treat it as a non-current liability. Sasa, so it is payable within 1 year, current liability. If it is payable beyond 1 year, it is a non-current liability. I hope that is well understood. So we do the same. We balance this account. This will give us what? We have 34. Basically, that will be 46 plus 240. That will give us 4840. 4840. So we have a balance carried down in the capital account for Ben of 2840. So for this, is 4,000 and 160. 4,000 and 160. 21 what? 60. 2160. Yes. So basically, those are the balancing figures. The balancing figures. So I want us to finalize now by preparing the statement of financial position. By preparing the statement of financial position. Let's finalize by preparing the statement of financial position. Statement of financial position as at 30th of June 2024. As at 30th of June 2024. 30th of June 2024. That year of June 2024. Yes. So let's prepare this one. So, and basically we will start by recording the non-current assets. The non-current assets. So we just need to have a single column here. And we start with the first non-current asset below paragraph 3 of our question. The first asset which you're given here is land. I hope you can see that. We have land. And I hope you can be able to recall land was revalued upward as per note number 9. So the value for land will not be 2.4 million or 2,400, but will be the value in note number 9, which is 32. Land was revalued upward. We record that figure here. So below land, we have buildings, and basically we take the cost, which is 64. So to this, we will less the accumulated depreciation at the start, which is given within those particular balances. Actually, it is below equipment here, which is for 80. And then to this, we less the depreciation for the current year, which we computed as per note number 5. And I think that was coming to 128. The depreciation for the current year, the one we recognized in the income statement, is it 128? Yes, 128. So give me the net book value at the end. We try to hurry up because of time. Net book value, Purity. Okay, I'm given that by Evans. 5792. 92. Okay, so below building, we have equipment. So for the equipment, you're given the cost, which is 960. We less the accumulated depreciation at the stand, which is just below that equipment, and that is 220. And then the depreciation for the current year. Was it coming to 144 for the current year? The one which you have in the income statement, was it coming to 144? Yes. So that will give us 596. 596. Okay. So below that we have, I don't think we have any other non-current assets. I don't think so. Yes. So we can proceed and we record now the current assets. The current assets. So for the current assets, I will start with what I have below accumulated depreciation. I have trade receivables. I have trade receivables. So the trade receivables is an amount of 1368. And then to this, I will less the allowance for doubtful debt at the end of the year, which is in note number 6, which is note number 6, an amount of 48. 48. I'll get what? I'll get 1320. I'll get 13 what? 20. I'll get 1320 there. I'll get 1320. I'll get 1320. So then from there, what else do we have? We have payables, which is basically a liability. And then we have cash at bank. Cash at bank. Cash at bank. So the cash at bank in that case is given as an amount of 84. 84. So then below that we have the capital, the current. Below that we have purchases, sales, salary, rent, general budget. Okay, those are not assets. And then in the additional information number 1, we have the closing inventory. We have the closing inventory. So what we record here is the closing inventory. As per note number 1 is 1.8. 1.8, that's what we have. In note number 2, we have rent and rates which were paid in advance. In other terms, we can just refer to that as prepaid. Prepaid rent and what? Rent and rates. And that is basically an amount of what? An amount of 100, which is a current asset. So then from there we have note number 3. These are expenses accrued. These are current liability. Note number 4 is about drawings, which basically I've dealt with. Note number 5, depreciation, you have dealt with that. Allowance number 6, allowance for doubtful debt number 6, you have dealt with that. Number 7, that one will be a current liability. This loan due from Anne. And then we are done with note number 8 about goodwill. Note number 9 about valuation of land. Note number 10. So it basically means that in our case, we are done with the current assets, and basically we can get the total. Let's get the total assets. The total asset. Let's get the total asset here. Okay, I'm given that by Nicole as 3204. 3204. Someone to confirm whether that is correct. Confirm. Is that correct? Is that correct? 12,892. 12,892. Okay. So then from there, we need to proceed and basically record the partners' capital account balances. Partners' capital account balances. And we get these from what we have here. Remember, at the end of the year, 2 partners were there. So Ben and Chadi. So Anne had already charged. That's why you can see we don't have any balance there. We don't have any balance there. So we have Ben, and then we have Chad. So these are the balances in their capital account, 2840, and basically 21 what? 60. So then from there we proceed and record the current account balances equally for Ben and for Chad. So these are the balances. You can see we don't have any balance in the current account of who? Of Anne. And basically these ones are credit balances because the balance brought down will be on the credit side, 20 and what? 20. So then from there, next we proceed and record liabilities. We proceed and record the liabilities. Okay. We proceed and record the liabilities. So for the liabilities, we always start by recording the non-current liabilities. Non-current liabilities. And basically, I've said this may take the form of a bank loan, in which case we don't have a bank loan here. And equally, what I've said is that if, for example, the amount which was due to Anne was to be paid for a period exceeding 1 year. So we also record that here as an non-current liability. So, but in our case, because it is payable within 6 months, that will be a current what? Liability. So in our case here, we don't have any non-current liability. So finally, we record the current liabilities. We record the current liabilities. The current liabilities. So for the current liabilities, in fact, we will start with the loan due, with the loan from Anne, the loan from Anne, the partner who retired. This amount we have said will be payable within 6 months. And basically around, it is 6140. Is it 6140? 6140? Is that the correct figure? The loan from Anne. The loan from Anne, yes. So then from there, we got back to the balances we have below paragraph 3. So we check which other liability we have. And I think we have the trade payables. So the trade payables is an amount of 1624. 1624. So then from there we have the allowance for doubtful debt, the cash, capital current, purchases, sales. Yes, we don't have any other there. But now if we go to the additional information note number 3, we have general administrative expenses which were accrued. So we have accrued general administrative expenses. And basically this is an amount of how much? Is an amount of 88. We are done with that. Note number 4 about drawings, we are done with that. Note 5 depreciation, we are done with that. Note 6, note 7, note 8, note 9, note 10. So basically in our case we are done. So what we need to do is we get the total. We get the total capital and liabilities. Total capital and liabilities. Total capital and liabilities. You tell me whether it is coming to this one, 12,892. 12,892 should reconcile with whatever you have here. Is it reconciling? Is it reconciling? Is it reconciling? Reconciling, yes or no? Yes, that is confirmed. That is confirmed. So basically, this is what was required in part B of that question. And basically, these are the items now which are marked. these are the items which are supposed to give you the marks which were allocated there. The 10 what? The 10 marks. The 10 marks. So that is it. That is the how we account, or basically how we prepare the financial statements of a partnership in case we have a partner who is retiring. And basically now that brings us to the end of that aspect of retirement. So basically what is remaining as far as this topic is concerned is to see how we account for the dissolution of a partnership. How do we account for what? The dissolution of a partnership. Basically, when we talk about the dissolution, this whereby a partnership business is discontinued, maybe due to a court order or as a result of a mutual agreement of the partners. In this case, we're going to look on how do we account for the dissolution of partnership business. So once the partnership business is basically dissolved, we know that its books of accounts are supposed to be crossed off, and basically the partners will be sharing maybe any a profit arising from what? From dissolution and so on. So that is basically what is remaining, and that is what we will be able to discuss once we meet in our next class. So that now we can be able to move to another what? To another topic. So actually, this is one of the topic which is a little bit wide, as you can see. But once we are done with this, we will be able to move to something else. So for today, I want us to stop at that point. I don't know whether there is any question before we wind up. Any question before we wind up, Juma? Any question, Benson, before we wind up? Any question, Eunice, Evans, Nicole, Peter, Purity? Any question? Any question? I think none. Okay, so we stop at that point for today. We stop at that point for today. We continue from there in our next class as we look on what is remaining, and that is dissolution of a partnership business. Dissolution of a partnership business. So have a good night. See you in our next class. Yes, so I want us to continue from where we reached in our previous class, and we started on this topic of reconstruction stroke reorganization. And basically, we said a company is reorganized or basically restructured if a company has been making losses for a number of years, or basically the company has been experiencing financial distress. In this case, we said there are two ways in terms of how the company may be restructured. We talked about the internal reconstruction, which is also known as a capital reduction. And number two, we talked about the external reconstruction, merger, and also what absorption. So what we were able to do in our previous class, we discussed what is internal reconstruction, which we said this basically entails reorganizing the capital structure of the company. Number one, by writing off the accumulated losses, basically reducing the share capital, and also doing what? Revaluing the asset, and basically trying to reduce the liabilities of what? Of the company. And actually, we said to account for the internal reconstruction is quite simple. We just apply the concept of double entry. And the main account which is prepared, we said, is a capital reduction account. So in today's class, I want us to move and basically we look on what is external reconstruction, merger, and basically absorption, and how do we account for this? How do we account for this? So we will start by defining these three terms here. That is external reconstruction, external reconstruction. We basically see what this entails. We also define what is merger, and basically this one is also known as amalgamation. Then number three, we also define what is absorption. So to start with the external reconstruction, basically this whereby a company which has been making losses or which has been going through financial problems or through financial distress will be liquidated, and basically its operation or its business, assets and liabilities taken by a new company which will be formed for that what? A purpose. So here, the company which has been going through financial problems, assuming it is company X, this company will be liquidated, and basically its business, assets and liabilities will be taken over by a new company, say company Y. So meaning that this is a new company, basically which is formed to take over the business, assets and liabilities of this what? A company which has been experiencing financial troubles, or basically financial what? Financial challenges, or basically which has been making losses. So therefore, in case of external reconstruction, once this company is liquidated, then its business and assets will be taken over by a new company, by a new what? A company. Now, this one is almost the same with this, but there is a slight difference. In case of absorption, basically what happens is that the business and also the assets and liabilities of a company which has been making losses will actually be taken over by an existing company. So meaning that the company which has been making losses will be liquidated, or basically will be wind up, and then its business operation, assets and liabilities will be taken over not by a new company, but will be taken over by an existing company. So therefore, in this case here, the company which has been making losses, assuming it is company X, and this company will be liquidated, and then its business operation, assets and liabilities will be taken over by a company, say company Y. And in this case, we are saying this is not a new company, but basically we are saying that this is an existing what? A company. I hope therefore you can see the difference between external reconstruction and also what? Absorption. So here the business, the asset and liabilities of this company which has been liquidated will be taken over by a new company. But in this case, the business, asset and liabilities of this company which is being liquidated will be taken over by an existing company. That is the difference between external reconstruction and absorption. So what do you mean by merger, or basically amalgamation? Amalgamation or merger, we know that this whereby two or more companies will be able to do what? Will actually be merged into a single company, will be merged into a single company. So assuming we have two companies here, maybe company A and company B, these two companies have been making losses, or maybe these two companies have been experiencing financial distress. The shareholders and also the directors of these two companies agree to do what? To liquidate the two companies, agree to liquidate the two companies. their business operation assets and abilities to be taken over by a new company which will be formed, maybe say company X. So meaning that here a new company will be formed basically to do what? To take over the business operation, assets and liabilities of these two companies which are being what? Liquidated. So therefore, in case of a merger or amalgamation, we say that the identity of these two companies will be lost because those two companies will be liquidated, and then a new company will be formed to take over the business operation, assets and liabilities of these two company. And basically a good example of a merger, we have a merger which happened in the banking sector some time back, the merger of two banks. The first bank was NIC, and the other bank was CBA. So these two banks merged, and the new bank which was formed after the merger is currently known as what? The NCBA. Ends what? CBA. So this is basically a bank which was formed after the merger of two banks. So we are saying the identity of these two banks or the identity of the two companies which are merging will be what? Will be lost, and basically a new company will be what? Will be formed. Now, if you have noted from all these particular definition, there is something which is common in all these forms of reconstruction. So one thing which is common is that this company which has been making losses, or in case of merger, the two companies which have been making losses, we are saying they will be liquidated. That is something which is common here. So once they are liquidated, then we are saying their business operation, assets and liabilities will either be taken over by a new company or by an existing company. That is also something which is common. And therefore, how do we account for this external reconstruction, merger and absorption? So to account for these three forms of reconstruction, we account for them in the same way. So here, we make two sets of accounting entries to account for this. And equally in this case, we account for this using the concept of double entry. So we make two sets of accounting entries. One, we make the first set of accounting entries to do what? To cross off the books, of account of the old company. This company which is being liquidated, we refer to it as the old company. In other terms, we refer to this company as the selling company. Why do we refer to it as the selling company? Is because once it is liquidated, then it is deemed to have sold its business to a new company, or is deemed to have sold its business to an existing company. So the old company which is being liquidated is known as the old company, or is known as what? The selling company. So here, which are the main accounts prepared here to cross off the books of account of the selling company, even before you look on the journal entries or the accounting entries. So here there are how many main accounts prepared? I think they should be 3 or 4. So the first one is called the realization account. And even before explaining this account here, there is something you did similar to this. If you can be able to recall in financial reporting and analysis, you did a topic for the conversion of a partnership into a limited liability company. Now, that aspect of converting a partnership business into a company is the same with this concept here. Because once you're converting a partnership into a company, a partnership was being dissolved, and then a new company was formed. So what we were doing in FR, we were crossing off the books of account of the partnership by preparing a number of accounts, including realization and opening the books of accounts of the new company, the same aspect which is applied here. So if you understood that topic of converting partnership into a limited liability company, this is the same concept applies here. We have to cross off the books of account of the old company. We prepare 3 main accounts: realization account, ordinary shareholders, sundry members account, The other account is called the preference shareholders, sundry members, account. And also there is another account which is prepared, known as the purchasing or the new company, account, the new company account. So those are basically the three accounts which are prepared basically to do what? To close the books of account of the old what? Of the old company. Do I give the journal entries, or basically do I give you what is recorded in each of these accounts? Let me give you what is recorded in each of these accounts. I think that one is a little bit simple for you to understand. So I want us to look on what is recorded in each of these accounts. So basically, you can have our 4 accounts here. Our 4 accounts. Basically, we are saying that these are the accounts which are prepared to close off the books of accounts of the owned or the selling company. The first account is the realization account. Realization account. What do we record in this particular account? The realization account. On this side, first of all, we record the assets. The assets which are taken over by the new company, at their net book value. So once the old company has been liquidated, some of the assets will be taken over by the new company. So those assets which are taken over and at their net book value, because it is important for you to note that whenever the assets are taken over by the new company will take them over at their current market value, at their fair value. But when closing off the books of account of the old company, we record those assets here at their net book value, not at their fair value. Then the other account, maybe you can have it here, ordinary shareholders, sundry members account. Now in this account, we have those particular assets which will not be taken over by the new company, especially the intangible assets, like the goodwill, the patents, they will not be taken over by the new company. So we say those are the assets which are written off. So there are those particular assets which are written off. So those particular assets which are written off at their net book value, they are basically debited here. So in that case, you can see from the statement of financial position of the old company, we have dealt with the asset. So the asset of the old company can either be taken over or written off. Then from there, after closing off the asset account in the books of account of the old company, we go to the share capital and reserves. Share capital and what? Reserves, and then liabilities. Now, for the liability, for the ordinary share capital, that is ordinary share capital and reserves. So what we record here on this side is the ordinary share capital. So remember, this company will be having ordinary share capital. So the ordinary share capital of the old company is crossed off to this account, basically credited here, plus any reserve. Plus any what? Reserve, e.g. the share premium. So because here you need to remember that a statement of financial position of a company, what is recorded there? Assets. From there, we have what? Equity. From there, we have what? Liability. So when closing of the books of account of the old company, you cross these items systematically. Don't skip any. You start by crossing the asset. And I've said for the asset, we have those assets which are taken over. The other asset may be written off. Asset taken over at the net book value, debit them there. Assets which are written off at the net book value, debit them here. And then you go to equity. Equity, we are saying this comprises of share capital and reserves. So the ordinary share capital and reserves, they are credited here, except the accumulated losses. The accumulated losses, that one should be debited in this account. Remember, the company which is to be liquidated will be having accumulated losses. So then from there, still at the equity, we may be having preference share capital. So the preference share capital is crossed off to an account which is called preference shareholders, sundry members account. Sundry members what? Account. Sundry members account. So on this side, we record the amount of preference share capital. the amount of preference share capital. So once we are done with that, we proceed to the liabilities. So for the liabilities, we have those particular liabilities which will be taken over by the new company. So the liabilities which will be taken over by the new company. So the liabilities taken over by the new company, those liabilities are basically credited here. The liabilities which are taken over, and always the liabilities are taken over at their net book value. Liabilities are not devalued. If the old company had a bank overdraft of 2 million, you cannot devalue your liability. It will be taken over at 2 what? At 2 million. At 2 what? At 2 million. At 2 million. Then, after closing of those particular accounts which had balances here, there are other items which you may also be required to account for, which are not part of this. They are given in the additional information. One of it is something called the preference dividend in arrears. So the amount of preference dividend in arrears is basically debited here and then credited in this account. A preference dividend in what? In arrears. So that is the double entry. Debited share, credited share. And then number 2, we also account for something called the purchase consideration. Remember, you have said that once the new this